Okay, so Reg A plus over VC, you don't have external board member seats to, powerful people that have a lot of clout in your company. So you are more likely to stay on board as a CEO and be able to adhere to your strategy, right or wrong, right? I mean, there are times when their value added up there can be really useful. So it's not a complete no-brainer. And much less dilution because in my experience, in a Reg D with angel investors or VC, that's, it's a fair deal. You raise enough money to grow the company a year and a half, you're going to give up 25 to 33% ownership in the company. And then when you do it next time, we'll have the same kind of dilution unless you're, experiencing very, very rapid growth. So lots of dilution there and a lot less dilution in a Reg A plus. If you look at the numbers and observe what kind of valuations Reg A plus that are offerings that are legitimate and that are well received and accepted carry, there's less dilution, okay? I'm not a valuation professional, but let me just leave it at that, substantially less dilution. As well as liquidity. We have venture funded companies approaching us because the VCs introduced them because they want to get liquid. And, there's reasons with VCs where they fund it as much out of fund 2 as they can. The company still needs money to grow and they aren't allowed to use fund 3, 4, or 5 to put more money in. They need to get other investors in or they need to raise money through another method. So we've had VCs come to us. I would say I have a tremendously good contact network in high tech. Not too many of those companies have been those that would do well in a Reg A plus so far, frankly, but some of them can and will, obviously. Over time, that will become a viable and attractive portion of our business. It's a matter of which companies when, right? So liquidity is a big advantage in Reg A plus, and I'll get into that further later on because there's some pleasant surprises beyond the obvious there.